Let me ask you something. If both of your companies dropped 40% in the same quarter, what would happen to your net worth? If you and your partner both work in tech, both have equity, and you have never actually answered that question, you are not alone. It is one of the most common blind spots I see. Here's a situation. 2 careers, 2 equity packages, 2 brokerage logins. You each track your own grants, you each set your own withholding, you each make your own calls about when to sell. It feels organized, it feels responsible. But here's the problem. You do not have 2 financial situations. You have one. The mortgage is one number. The tax return is one number. And the risk, when both of you hold stock in fast-moving tech companies, is very much one number. Today, I'm going to walk through how to take 2 compensation packages and build a single plan from them. We will cover coordinating your vesting and selling across 2 employers, measuring the concentration risk you actually carry as a household, and handling 2 W-2s with different equity structures on one joint return. Let's get into it. The first move is a mindset shift, and it is the one that unlocks everything else. You are not each managing your own equity. You are co-managing one shared balance sheet that happens to have 2 sources of income. Here is why that matters. When each partner optimizes alone, you get decisions that look smart in isolation and poor together. One of you sells RSUs the same week the other is holding for a long-term gain. One of you is buying company stock through an employee stock purchase plan, while the other is already heavily overexposed. Both of you set your withholding as if your paycheck were the only income in the house. A single household plan starts from shared questions instead of separate ones. What is our combined exposure to tech equity right now? Which grants vest in the next 12 months, and what will they be worth? What is the one goal these packages are actually funding? A home, a sabbatical, college, early independence? Once those answers are joint, the individual decisions get easier, because now each of you is playing the same position on the same team instead of running 2 solo games that happen to share a roof. So let's talk about timing, because this is where coordination pays off. 2 grants from 2 companies almost never vest in sync. One vests monthly after a 1-year cliff, another vests quarterly. Another runs on the company's own annual cycle. Left alone, that creates a lumpy, unpredictable stream of taxable income landing at random points all year. Coordinated, it becomes a tool. When you can see both vest calendars on one page, you can plan which shares to sell and when instead of reacting grant by grant. Now, my default for most people is to sell RSUs as they vest. Here is why. A vested RSU is just cash the company handed you and asked you to immediately rebuy its stock with. If you would not take your bonus and pour all of it into a single stock, you should not hold vested RSUs by default either. Holding is an active decision to concentrate. It is not the neutral choice it feels like. And coordination lets you put sales in the right year. If one partner has a lighter income year, a leave, a sabbatical, a startup stint with a low salary, that is often the better year to realize gains from the other partner's concentrated position. You can stagger diversification across 2 people and 2 calendars in a way a single earner simply cannot. That flexibility is real money, and most couples leave it on the table every year. Now here's where running 2 plans separately gets genuinely dangerous. Each of you looks at your own holdings and sees a position that feels reasonable. But combined, the household can be wildly overexposed, and neither person ever sees it because nobody is adding it up. And it gets worse when the 2 companies move together. 2 large public tech employers or 2 venture-backed startups are not independent bets. They tend to rise and fall with the same interest rates, the same hiring cycles, the same market moves. So your real risk is not your stock plus their stock. It is 2 correlated positions stacked on top of 2 paychecks that also depend on the same industry. If the sector turns, your equity and your income can take the hit at the same time. That is the 40% scenario I opened. So here is the exercise. Add both positions together. Look at the total as a percentage of your investable net worth, and judge that one number as a household, not your slice, not their slice. The combined figure is the one that tells you whether you are actually diversified or just comfortable. Last piece, the taxes. 2 equity packages rarely come in the same shape. One of you might have straight RSUs. The other might have incentive stock options with alternative minimum tax exposure, an employee stock purchase plan, or options with their own timing rules. These do not get taxed in separate buckets. They all land on one joint return and they interact. The most common surprise is under withholding. Your employer withholds on vesting RSUs at the flat federal supplemental rate. For most dual income tech households, that rate sits well below the marginal rate you actually reach. Each company underwithholds on its own grants, and neither one accounts for your spouse's income. The gap compounds across two packages and shows up as one number in Able. Planning across the two structures is where you save real money. Two incomes together can push your investment gains past the surtax thresholds that hit higher earners, which raises the stakes on how and when you sell. If one of you holds incentive stock options, the AMT math has to be run against the household's full income, not just that one salary. None of this is visible from inside of a single brokerage login. It only shows up when both packages sit on the same page, projected together before the year closes instead of after. So here's the bottom line. You do not have his plan and her plan. You have one balance sheet with two engines, and the wins come from running them together. One combined view of vesting, one deliberate selling strategy, one honest measure of concentration, and one tax projection that accounts for both packages at once. Two equity packages are not twice the complexity. Coordinated, they are twice the opportunity. If you want to talk through your specific situation, the link to schedule a call is in the description. And if you haven't subscribed to Vested yet, my weekly newsletter for Bay Area tech professionals, the link for that is down there too. I'll see you next week.